So fractional reserve banking is a key aspect when it comes to modern financial systems. And understanding it is also essential for you and anyone else interested in building wealth. So if you're curious about what would happen if the fractional reserve banking system collapsed, well, revert back to the Great Recession and you'll see the closest we've ever come. So keep watching as I explain how you can ensure that you're covered in the event of a catastrophic event like a collapse of the fractional reserve banking system. So the first thing I want to talk about is I want to talk about the difference between fiat versus asset-based currency. Most of you understand what this means. Almost all money in circulation, I don't care if it's the US dollar, the euro, the yen, whatever it is, it's all fiat money. So what that means is this money has nothing behind it. There's nothing that stands behind this to value it. It's literally money printed on a piece of paper, and the value of it really only is determined by our confidence in it and the confidence that the dollar is going to be able to buy things. Now, you can very quickly lose confidence in a currency or in the dollar, just like in Germany, they lost confidence in their money and it took a wheelbarrow full of money to buy a loaf of bread. Now, there's a lot behind that, but I want you to understand that fiat money is all there really is today. Now, let's talk about the old days, the good old days, as I like to say, where we had asset-backed currency. You know, during the world wars, World War II specifically, our dollar was backed by gold. And we owned about 80%, give or take, of all the gold in the world, which backed the US dollar, which gave our money significant value. So to understand the difference between fiat versus asset-based currency, it really just comes down to asset-based currency is backed by something like gold. So number two, let's look at a history lesson here. Let's look at a quote from Max Kaiser. Now, this is from the Huffington Post. The Romans, to pay for the cost of maintaining the giant empire that they had built, what they started was the debilitating cycle of inflation by expanding their money supply. They accomplished this by clipping bits of gold from the existing coins in circulation. So many of you have heard this story. If you haven't, it's a really fascinating one because it's kind of the same thing going on today. So every coin in circulation, when it came back through, they would clip the corners. And they would use that to increase the money supply. They used the purloined gold flakes to mint new coins. And the coins in circulation kept getting smaller and smaller and smaller. And the empire kept getting bigger and bigger and bigger. Prices went up while the purchasing power of the clipped coins went down. Now, let's fast forward to today. In America, the cost of maintaining the empire, the United States of America, has prompted the government to start the debilitating cycle of inflation by expanding the money supply. You've all seen this firsthand. Some of you remember during 2008, to stop the complete collapse, they printed $900 billion. They never stopped printing. As a matter of fact, it didn't start then. It started well before that. But just recently, during the pandemic, they printed $5.1 trillion. $5.1 trillion. Folks, that's no different than what the Romans did clipping the corners of the coins. It's debilitating. And the same thing is happening here. As our empire gets bigger, our dollars are losing purchasing power, which is why so many of you and so many people out there are struggling right now to understand or to keep up with the cost of goods and services. I just saw orange juice, just a small pint of orange juice, or maybe it was a quart, was $14. How much are eggs now compared to what they were 3 years ago? We could go on and on. This is all because of this cycle. So let me just go back to that Roman example. So what is gold clipping? Well, the ancient Romans, they used to mess with their money. Okay, they would take the little coins and they'd clip the corners of them off, right? And then they would make new coins out of those clippings. They did this to create more money, which they then had in reserve, okay? That money that was in reserve is a form of fractional reserve banking. Now, it let them borrow money. And in borrowing money, it let them inflate their money supply. But it also made their money worthless. And it contributed to the collapse of the entire Roman Empire. So then you're probably asking, how are gold clippings from back in the day and the fractional reserve banking of today similar? Well, Both the ancient Romans and modern banks mess up their economies by issuing more money than they have in the reserve. This can cause inflation, this can make their money worthless, and it can cause exactly what you're seeing today, financial instability. And if people lose faith in their currency, and if they lose faith in the complete and utter financial system, it's going to be bad news. Let me just show you something here. I want to just show you how banks work, and then I want to take that into another thing and show you what fractional reserve banking is, because some of you still don't really understand this. But how a bank works is banks have convinced us to deposit our money into their bank because that's where we feel safe and secure to put our money. So we make money, W-2 income, 1099, however you make money, and then that's your income. And then you make deposits into their bank. But the bank doesn't keep the money in their vaults. The bank pays you interest on your money and then immediately lends that money back out to somebody else at a higher interest rate. They pay you 4, that's if you're lucky today, I'm just using an example, and they charge you 7 for a house. I've been doing this example for a long time, and it's funny because when I first started doing this, we were in low interest rate cycles where no one was getting 4% in their bank account, but nobody was paying 7% for a mortgage. Isn't it funny how the times have turned? Because now, this is actually not too far from the truth. And when the bank lends the money back out, somebody else gets a windfall of money for the asset that they sold, and they put that money back in the bank, and the bank then moves that money back out in another loan, 8% for a car loan, coming to a theater near you. The dealer gets the money, puts the money back in the account, the bank lends it back out. Home equity line, 9%. Pay the contractor puts the money back in the bank. And then the bank lends it back out, 12% for a debt consolidation loan. The credit card companies get the money that you paid them back and it goes back in the bank. Round and round we go through the banking system, and each time this money went there, the bank made a spread. In this example, if you add up the spread on each one of these, the bank made 20%. Okay? And the bank took very little risk in doing this. Matter of fact, the bank had collateral in each one. They had a house here collateralizing it, a car here, a second position on a house. This is the only one that was uncollateralized, but it was a really high interest rate. Risk versus reward. The bank understood the risk of an unsecured loan was higher, so therefore they charged a higher interest rate. The bank wins, and you think you won because they're paying you 4%. Let's move on. This is where the fun really starts. This is the simplest way I can explain fractional reserve banking to you. So let's start with you. You take $100 and you put it in your bank account, and the bank pays you 1 to 2%. Don't get hung up on the numbers. They pay you an interest rate. The money goes into the bank. That $100 now is in the possession of the bank. Now the bank has to take 10% and they have to save that in reserves. Okay, and those reserves can be invested in guaranteed investments, which is why banks put a large sum of their money into whole life insurance policy. Look it up, BOLI, bank-owned life insurance, because it's guaranteed, and the rest goes into things like treasury bonds. But they had to keep only $10 of the $100 you put in. So the $90 is money out of thin air that they then get to lend back out. So they lend $90 to Jill, and they lend it to Jill at 5%. Jill uses that $90 to buy these awesome Nike SB Dunks from John for $90. So Jill uses the bank's $90 loan to give to John. John now trades the shoes to Jill, but John's got $90. So John does what most of you would. He puts $90 in the bank. The bank takes the 10%, which is $9, and puts it in reserves. So remember, the bank has now taken in the total of $190, but the bank only has to keep $19. The rest is Fiat, is fractional reserve banking. Okay, so $81 now is what the bank actually can lend out based on that deposit. The bank then lends that $81 over here to this guy, Billy. And Billy is going to pay 10% interest to the bank for that $81 loan. But to Billy, that 10% makes sense because he's going to pay off a Visa that is charging him 20. So to Billy, 10 is less than 20, so Billy's making out. To the bank is psyched because they're making 10% off of Billy's loan. So Billy pays the credit card, Visa, off for $81. Visa deposits the money in their bank, $81. The bank has to keep roughly $8.10, but we'll just round it down to 8. So in reserves, the bank puts $8. And the bank has $73 now of the $81 to then lend out. The bank repeats this over and over. The bank has an insurance policy by the government called FDIC, which will guarantee up to $250,000 worth of deposits. This is a scam. Look up FDIC and how much money they actually have. But you can feel good that, yes, your money's probably protected up to $250,000. Anything more than that, well, we need to talk. The bank keeps records of these loans. Every one of these loans, bank has records of them. They keep records of all the deposits. And they keep records of the reserves. Your $100 becomes $1,000 to the bank through fractional reserve banking. Does that make sense? Nothing really crazy happened here. But because of how fractional reserve banking works, the bank literally, almost out of thin air, was able to print new money and make that new money go to work for them over and over and over again. But let's just quickly recap what just happened. You deposited $100. Jill had $90. Billy had $81. And $73, we never got that far. That's $271, okay? $271. Fractional reserve banking means that $100 equals $271 because this 100 produced $90 out of thin air. This $90 produced $81 out of thin air. This $81 produced $73 out of thin air. So $100, the original deposit you made, turned into $271 of fiat money plus interest that the bank charges. Pretty cool, huh? How many of you want to mimic what the bank does? Well, although you can't mimic fractional reserve banking, you'd go to jail. They would call that a Ponzi scheme or something else. You can change just one thing, and you can change who controls your money. This is not hard. So you can do it very simply by changing what you do and where you put your money first. We call it privatized banking. It's been around for a long time. And privatized banking will allow you to take back control of your money, allow you to mimic what the bank does every time with all those different things we talked about: car loans, credit card debts, colleges, boats, vacation, lines of credit, all that stuff I just showed you. You can control money flow in and out of each and every single one of those. It's just like a big circle. The money comes over here, you buy a car, you make a car payment back to your bank. The money comes out of here, you pay off debts. The money you used to give to the debts comes back to you. The money comes out of your bank and pays for college. The college payments go back to your bank. I could go on and on. So you might not understand everything I just showed you a second ago about moving your money and the infinite banking concept, but that's why I have hundreds of videos that you can watch. So let's just pause and let's subscribe to this channel right here, right below. Click that little subscribe button, and then right up here, or maybe it's up here, there's a little bell. Smash that bell so that you're notified every time I put up a new video. Speaking of new videos, if you like this one, check this video out right here. It's called Economic Collapse, My Survival Plan. See you on the next one.